With $81.6 billion in Q1 revenue crushing expectations, the market is completely missing the underlying trap. But does this historic surge mean Nvidia is an unstoppable force for your portfolio? Or is a hidden structural illusion about to shatter these massive gains? When you examine the 85% year-over-year revenue growth that Nvidia just reported, the fundamental reality quickly shifts. The mainstream narrative claims Nvidia is simply selling more chips, anchored heavily by that staggering 74.9% gross margin. Gross margin measures the pure profit left after direct manufacturing costs are paid. At first glance, a 74.9% gross margin looks like absolute outperformance for a hardware company, making ordinary investors feel secure. Most professionals conducting stock market analysis extrapolate this specific trend, assuming unending technological dominance and endless demand. But when you see the operating margin explode to 65.6%, the picture changes entirely. Operating margin tells us exactly how much profit remains after all regular business costs, like salaries and marketing, are paid. Nvidia operates with software-level profitability metrics powered entirely by a massive artificial intelligence compute supply imbalance. For your investing strategy, the golden rule is that valuation multiples will heavily punish any drop from that peak 65.6% operating margin. If custom competitors suddenly crack that dominance, the market premium evaporates instantly. To fully grasp why this profitability is happening, you must look at something deliberately hidden in the bottom line. Diluted earnings per share climbed to $2.39, delivering a massive 214% diluted earnings per share year-over-year growth rate. Earnings per share equals total profit divided by outstanding shares, which typically shows true business efficiency. The financial media constantly calls this $2.39 diluted earnings per share a total operational victory for Nvidia. But the terrifying twist is that net income exceeded operating income purely due to a $15.94 billion non-operational gain from equity securities. This $15.94 billion non-operational gain creates a massive earnings illusion, masking actual cash generated. As an intelligent investor focused on fundamental analysis, you must completely strip away these equity markups when assessing the core business. This is exactly why relying on an inflated $2.39 diluted earnings per share is dangerous for your long-term wealth. Yet, if current earnings are propped up by outside investments, how secure is their actual customer demand? This brings us to the real elephant in the room regarding future demand constraints and geographic bottlenecks. Management just established a Q2 revenue guidance of approximately $91 billion, signaling unyielding optimism. Most commentators doing stock market analysis see this $91 billion Q2 revenue guidance as absolute proof that Nvidia faces zero macroeconomic headwinds. But the shocking truth is that this forecast explicitly assumes exactly $0 in China data center compute revenue. Modeling exactly $0 in China data center compute revenue transforms this guidance into a massive stress test of global demand. For your personal investing strategy, hyperscale demand in allied markets must remain absolutely flawless to support the stock. If Nvidia ultimately stumbles, it will be because this geographic concentration risk finally shatters that $91 billion Q2 revenue guidance projection. Despite these strict geographic restrictions, the company is wielding immense financial power directly against its core competitors. Nvidia generated an unbelievable $48.55 billion in free cash flow during the last quarter. Free cash flow represents the actual liquid cash a business produces after covering all operating expenses and mandatory investments. Generating $48.55 billion in free cash flow translates directly to an elite 59.5% free cash flow margin. The common belief in value investing is that a 59.5% free cash flow margin means the company has extra cash. However, the board just approved a massive $80 billion share repurchase authorization, completely reframing their entire long-term capital strategy. Nvidia already deployed $19.31 billion in Q1 buybacks, rapidly accelerating their direct market intervention to support the stock. You must combine this staggering capital return with a 2,400% dividend increase, bringing the quarterly dividend to $0.25. The real lesson here is that Nvidia is signaling supreme confidence in their future cash generation capabilities, acting like a mature powerhouse. What does this massive strategic shift actually mean for your own portfolio positioning in the coming months? It means the broader market will heavily penalize any future quarter where that $48.55 billion free cash flow metric compresses. To understand if that cash engine can survive, data center networking revenue suddenly exploded to $14.8 billion, proving that the overall infrastructure build-out is widening. Delivering a 199% data center networking revenue year-over-year growth rate suggests customers are buying entire artificial intelligence factories. Pulling in $14.8 billion in data center networking revenue looks like a perfect growth engine, but it comes at a steep price highlighted by the $8.5 billion Q2 operating expense guidance. Operating expenses track all the critical day-to-day costs like advanced research, development, and global marketing. Pushing aggressively toward that $8.5 billion Q2 operating expense guidance means development costs are accelerating rapidly just to roll out new hardware platforms. For your portfolio, this directly indicates that the actual cost of maintaining a monopoly is rising exponentially behind the scenes. The golden rule in fundamental analysis is that maintaining that $8.5 billion Q2 operating expense guidance is only acceptable if it continually unlocks new monopolies. But what exactly happens when a dominant chip company decides it no longer just wants to sell physical hardware? That inevitable transition requires acting as the foundational financial architect of the entire global ecosystem. Nvidia holds $80.5 billion in immediate liquidity, fortified by a highly conservative 4.3% debt-to-equity ratio. This 4.3% debt-to-equity ratio compares total liabilities to shareholder equity, making the company practically bulletproof against sudden credit tightening cycles. But instead of saving that $80.5 billion in immediate liquidity for a rainy day, Nvidia actively deployed $18.58 billion into non-marketable securities investments. Funneling exactly $18.58 billion into non-marketable securities investments means Nvidia is buying massive private stakes. As an intelligent investor, your publicly traded shares are now directly exposed to the highly unproven valuations of private startup companies. This explains why your portfolio feels wildly unpredictable when the company uses that $80.5 billion in immediate liquidity to act like a sovereign wealth fund. The ultimate verdict is that Nvidia is executing the most lucrative infrastructure monopoly in financial history. However, those shiny headline earnings mask severe underlying dependencies on continuous hyperscaler spending and volatile private market markups, putting that 74.9% gross margin at structural risk. For your own portfolio, the real danger is ignoring exactly how fast the operational cost of aggressively defending this dominance is rising today. Therefore, I predict that within the next 24 months, the hardware market will face a brutal margin reckoning, forcing Wall Street to violently reprice Nvidia based purely on software lock-in rather than sheer silicon dominance. But I want to hear your take. Do you think their $80.5 billion in immediate liquidity will protect them from competitors, or are they walking into a costly trap of their own making? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.